Revenue growth is often the first metric that attracts attention when evaluating a company. A rapidly expanding top line can signal strong market demand, product adoption, or successful business strategy. However, revenue growth alone does not provide a complete picture of a company's financial health or investment potential. Investors must look beyond the headline numbers and evaluate profitability, margins, operational efficiency, and sustainability of growth. Focusing solely on sales figures can be misleading, as rapid revenue expansion can sometimes mask underlying weaknesses, structural inefficiencies, or risk exposures that could negatively affect long-term value creation. SMCI, widely known simply as Supermicro, provides a relevant case study. The company specializes in high-performance servers, storage solutions, and enterprise computing hardware. In recent years, Supermicro has benefited from a surge in demand for AI-enabled infrastructure, as businesses and technology firms globally have invested heavily in artificial intelligence and high-capacity data processing solutions. The company's growth trajectory has been notable, driven by this broader trend in the technology sector. The most recent quarterly results further highlight the strength of this top-line expansion, with net sales rising at an exceptional pace. Yet, despite these impressive revenue gains, an in-depth examination of the company's financial statements reveals several factors that caution against assuming the stock is an automatic buy. This analysis is provided for informational purposes only and does not constitute financial advice. A critical metric to consider when analyzing growth-oriented companies is gross profit. Gross profit, calculated as revenue minus the cost of goods sold, represents the portion of revenue available to cover operating expenses, research and development, marketing, and overhead. It is a key indicator of how efficiently a company converts sales into resources for further investment and operational sustainability. Companies with high gross margins have more flexibility to reinvest in growth initiatives, weather market fluctuations, and generate sustainable earnings. Conversely, low or declining margins can indicate structural challenges, limiting the scalability of growth even in the presence of strong revenue trends. Supermicro's recent financial performance highlights this dynamic. During the fourth quarter of 2025, the company reported net sales of $12.7 billion, a 123% increase from the prior year. At first glance, this represents extraordinary growth, suggesting robust demand and a successful business model. However, gross profit increased by only 19%, reaching $798.6 million. Operating income rose by 29% to $474.3 million. While these figures reflect solid absolute gains, they illustrate a significant disconnect between revenue growth and profitability. The company's gross margins remain in the single digits and have been trending downward, a signal that the cost structure may be constraining the translation of sales into meaningful earnings. Guys, 79% of people watching don't like or subscribe to the videos, so please take a second to hit that like button and subscribe. It really helps the channel grow. The disparity between top-line growth and profitability is not uncommon in companies operating in high-demand, capital-intensive sectors such as AI infrastructure. Supermicro's products, while in demand, carry substantial production costs. When gross margins are thin, even strong revenue growth can fail to generate proportional increases in net income. This phenomenon underscores the importance of analyzing not just revenue, but the quality and sustainability of that revenue. A business with low or declining margins faces significant operational leverage risk, meaning that any slowdown in demand or pricing pressure could have an outsized impact on earnings. From a valuation perspective, Supermicro trades at approximately 25 times trailing earnings. On the surface, this multiple may appear reasonable, particularly given the company's position in the AI and server markets, which have been experiencing strong growth. However, it is crucial to contextualize this valuation against the operational realities. The recent revenue expansion has occurred under exceptionally favorable conditions, including substantial capital investment by large technology firms in AI development and data infrastructure. These conditions have created a temporary environment in which high-volume sales can drive apparent profitability despite structural margin limitations. As the broader technology investment cycle inevitably moderates, and as the rapid pace of AI adoption stabilizes, Supermicro may face headwinds that could materially impact earnings growth. The company's historically rapid revenue growth has provided a cushion that allows operating income to increase, but this relationship is contingent on continued high levels of demand and capital investment. Any slowdown in spending on AI infrastructure or enterprise servers could expose the company's low-margin structure, leading to a disproportionate effect on profitability. Investors evaluating supermicro must also consider the competitive dynamics of the enterprise server and data center markets. The industry is highly competitive, with several large players vying for contracts and market share. While Supermicro has established itself as a reliable supplier, competition from other manufacturers with greater scale or more efficient cost structures could put pressure on pricing, further challenging margins. In this context, even if revenue continues to grow, the ability to maintain operating leverage and sustain earnings growth becomes uncertain. Another factor worth highlighting is the cyclical nature of technology spending. AI infrastructure and enterprise servers are subject to fluctuations in corporate capital expenditure, global economic conditions, and shifts in technological priorities. Supermicro's current performance benefits from an ongoing AI investment cycle, but historical patterns in the technology sector suggest that these cycles eventually decelerate. When that occurs, companies with high revenue but low margins are typically more exposed than those with robust profit structures. Supermicro's current valuation, at 25 times trailing earnings, therefore carries a level of risk that should not be ignored. While the stock benefits from being positioned in a high-demand sector, the combination of low and declining margins, dependency on favorable market conditions, and potential cyclicality of technology investment creates uncertainty regarding the sustainability of future growth. Investors should carefully weigh these factors, recognizing that strong top-line growth is insufficient on its own to justify investment in the absence of durable profitability. In conclusion, Supermicro demonstrates both the opportunities and limitations of investing in high-growth technology companies. The company's revenue performance is undeniably impressive, reflecting strong demand for AI-related server solutions and the ability to capitalize on favorable market trends. Yet, a closer examination of the underlying financials reveals structural challenges, including single-digit and declining gross margins, and a notable gap between revenue growth and operating income expansion. These factors, combined with potential moderation in AI investment and competitive pressures in the enterprise hardware market, suggest that caution is warranted. For investors, the key takeaway is that revenue growth, while important, must be complemented by robust and sustainable profitability to support long-term value creation. Supermicro's current financial profile, while attractive on the top line, presents a complex risk-reward scenario. Any decision to invest should carefully consider the company's margin structure, operational leverage, and sensitivity to broader technology spending trends. Without these considerations, the impressive headline growth numbers may overstate the company's actual investment potential. Ultimately, Supermicro illustrates a critical principle in growth investing. Strong sales growth is an encouraging signal, but it is only one part of a broader financial picture. Margins, operating income, competitive positioning, and the sustainability of market conditions all play a central role in determining whether a company represents a sound investment. In the case of Supermicro, investors should recognize that despite exceptional revenue growth, the company's low margins and dependence on a favorable AI spending environment create uncertainties that cannot be ignored when assessing its long-term prospects.